Hello and welcome back to my money vlog. It is already the beginning of April, but this is my portfolio update for the month of March 2022. Overall, March was a really good month. I'm quite happy with it. And what I did is I invested the rest of my pension money from Switzerland. And I'll just go through the different stocks that I bought now. My economic outlook has not really changed. I still believe that we're going to have to cope with higher inflation for a prolonged time, and especially in the second half of 2022, in the third quarter and in the fourth quarter, I would expect gold prices to go substantially higher, and therefore I bought some more gold stocks. The first one I bought is Yamana Gold. I bought 260 shares in this at the beginning of March, worth about £1,000. Next, I bought two low PE, high dividend paying shares as part of my value side of the portfolio. I did this a few days later on March 9th, and the first company I bought is Tesco. Tesco is the largest supermarket here in the UK, a very large company, and they pay about 3.3% in dividends. People will always have to eat, so they might cut back on other costs, but supermarkets like Tesco should continue to do relatively well. I put about £750 into that company. The second one is a German chemical company, BASF. They had gone down in price a lot because of the Ukraine war. So I decided to take advantage of this, bought 25 shares for about £1,000. One day later, on March 10th, I bought yet another company, namely a wind turbine manufacturer called Siemens Gamesa. I already have one wind turbine manufacturer, Nordex, and now I have a second one. I think if this is not the time for wind and renewable energy to be built up, then when is? So even though this company is losing money right now and it has gone down in price a lot and they're not paying a dividend, I still bought it hoping that this is the time for this particular industry to shine. And then finally, on March 21st, I bought one more gold company called Newcrest Mining. This is the first company I bought in Australia. So it cost me 1,500 Australian dollars, which is about 870 British pounds. And I will receive my dividends in Australian dollars as well, which I like some diversification in terms of currencies, and also another jurisdiction that is safe and sound for gold investments. So I'm quite happy with this company as well. So in total, I invested £4,478.70p, almost £4,500 into the stock market. That means I am now fully invested. All of my cash savings from my Swiss pension are gone. I'm now 100% invested in the stock market with my savings. Let's hope it goes well. Overall, the month of March was very positive for my investments. My portfolio now has a value of £30,685.82p, which I think is really pretty good. And for the first time ever since I started investing 1 year ago, my performance is actually positive. I am in the green by 0.89%. I was actually up even more at an earlier stage in March, but then during the second half of March, risky investments, momentum stocks, meme stocks came back, which is very different from how I invest. And so the kinds of safer, value-oriented investments took a dive. So I actually went down a bit towards the second half of March, but I'm still in the green. I'm still positive. So I'm very, very happy about this. And I'm hoping that my kinds of investments will continue to do well in the near future. Okay, I would also like to talk about big events, important economic news from the month of March and how they relate to my general economic outlook and to my investments. So I guess the biggest news of this month was that the Fed finally got around to hiking interest rates. The Fed funds rate is now 0.25%, and that happened on March 16th. Also, the Bank of England has now raised interest rates 3 times to 0.75%. And these interest rate hikes are badly needed too. For example, inflation in the Eurozone was 5.8% for the month of February before the Ukraine war happened. Or producer prices in Italy were up 40%, that's very high. US inflation, as measured by the CPI, was 7.9%. That is as high as expected, but obviously it is very high. Potatoes up 20%, oil went to $140, gold was above $2,000 for a short while. That obviously happened under the influence of Ukraine. But what the war affected even more was wheat prices. Wheat prices are now at an all-time record high. Also, gas prices up sharply. And nickel was up. There was some craziness in the nickel market this month. The LME halted trading during the day as nickel was up 240%. Proper important commodity behaving a bit like a penny stock there. Crazy times. So in short, prices are going up. We have an inflation problem. So most economists, most financial commentators expect higher interest rates. That means less credit, less consumption, less home buying, less profit, and more defaults, more unemployment, more bankruptcies, more restructuring. And anticipating that, the stock market would normally fall at some point as people just try to hide out in cash. But this time we have high inflation, so you cannot just sell your stocks and go into cash, because then you'd lose 5, 6, 7% of your purchasing power every year. So what I think will happen instead is you will see the cracks in some areas first before the problems become obvious in other areas. So not the entire stock market will go down at once, but some sectors that are more vulnerable to higher interest rates than others will go down first. So I think that as a consequence of tighter money and anticipated future interest rate hikes, the craziest and riskiest businesses should go down first. What are those? Those are assets like meme stocks, like GameStop or AMC. These stocks are down overall, but they saw some explosive moves to the upside this month by 25, 40%. So it's just craziness. The craziness is continuing. AMC bought a gold mine this month. I mean, they're an entertainment business. Why are they buying a gold mine? It expresses the exuberance, the craziness. Cryptocurrencies, I think, should decline. Bitcoin not really up year over year, but also ended the month of March generally higher at about $48,000. Similar with the ARK Innovation Fund, those include a lot of high-flying momentum stocks, but that fund is also down overall, but saw a very nice increase in the second half of March. Same with Tesla. Tesla is under pressure, but this month we saw hype over a new car plant in Germany and a stock split, as if that makes any difference at all. But they're still more valuable than all the other car manufacturers put together, which is not normal. That's crazy. And also the Chinese tech companies were in the news this month. Companies like JD or Alibaba were up 30% in the middle of March, so also very big moves. So in summary, what I would consider to be the bubbly and riskiest part of the market, those stocks have been beaten up quite a bit, but they're not down for the count yet. So I expect them to go even lower as interest rates go up. But there is another sector that should also react to higher rates quickly, and that is the bond market. In anticipation of higher rates by the Fed, the bond market is raising rates. The 10-year Treasury went from under 2% at the beginning of the month to 2.5% by the end of the month. That's a huge move. So higher bond yields means lower bond prices. And we've seen things that the news labeled as a bloodbath in bonds or carnage in the bond market. And indeed, we saw an inversion of some parts of the yield curve. I think that happened on March 29th. The 2 and the 10-year note inverted, and this has been a very reliable signal of a coming recession. So if investors no longer want these momentum, money-losing growth and tech stocks, and they also don't want bonds, and they can't really go into cash either, then where will they go? Well, they go into something safer, into something more traditional. They will go into property, houses, and certainly we've seen house prices explode all around the world. And many countries have seen record high house prices. And yeah, in times of high inflation, having a home, investing in houses has traditionally been a good idea. It's probably a good idea to buy houses or homes. But they would also go into more traditional, boring, dividend-paying value stocks. For instance, March 17th, I saw China Resources Cement up 10%, and Bayersdorf announced higher prices. And what do you know? The stock didn't go down, it actually went up by 4%. Because people will always need shower gel, they will always need shaving foam, they just have to pay higher prices for it. And then if you believe that inflation will be an even bigger problem for even longer, well, you'd really buy more commodities, including gold. So the way I conceptualize the situation is that there is a continuum between the most to least vulnerable assets as they will react to high interest rates. And people will run from the more risky part to the safer part of this continuum. And it's all relative, of course, to the inflation rate. But let's just say, I don't know, inflation is 7%. So then the most vulnerable stocks would be things like meme stocks and the risky momentum stocks, and maybe things in the NASDAQ and the ARK Invest in cryptocurrencies and things like Tesla. So then if you increase them more, maybe 1.5%, short-term bonds should really come under pressure, and also things like the FANG stocks. And then if they go really high, 3%, 4%, housing prices should come down, right? So if mortgage rates are 6, 7, 8%, people can't afford houses, not as easily. They can't find buyers, so house prices should decline at that point. And if you go even higher, 4, 5, 6%, well, all the commodities should come crashing down, right? Oil and wheat and gold. So the higher interest rates go, the harder these asset prices will be hit. That then creates an incentive system to stop these rate hikes at some point. So if meme stocks or FANG stocks come down, then maybe private investors are upset because they're losing their savings. But if bonds go down as well, then pension funds might find it difficult to find the pensions for their members. How would a country like Italy or Greece like it if they had to pay 4, 5, 6% for their bonds again? You can't really have interest rates that are that high because governments are running large deficits. And if it becomes more expensive to finance your operations, what are large companies going to do? They will have to lay people off, you get a recession, and then once housing prices fall, you hit families. For many families, their house is their biggest asset. So you have a lot of pressure, a lot of political pressure to avoid this economic downturn and instead to halt interest rate hikes. And people or investors generally agree with this point, actually.
I mean, the assumption that the Fed is going to raise this year to almost 2%, raise next year to 3%, and there'll be very little economic repercussions or very little impact to markets, I think is highly misplaced.
Many people I've seen in the news question the Fed's ability to engineer a soft landing, as they say. So people acknowledge that higher rates will cause problems. They see a slowdown, they see a recession, and a lot of commentators use the word stagflation to describe this outcome. But people do disagree on 2 points. The first one is just how high rates can go until they have to stop, until the pain is too great. The consensus view is that we should have 11 rate hikes priced in for the end of the year. So this could, with some 0.5% hikes, go all the way to 2.5%. Some say as low as 1%, and some see interest rates even at 4% by the end of the year. And investors also disagree, and I guess that's directly related to the last point, on how sustained the current phase of inflation will be. Most people seem to believe that inflation will come down when the supply chain problems are solved, when the pandemic is over for good, when the Ukraine war is over again.
As we get into the second half of this year, we started having a lot of wage and commodity inflation in the second half of last year. So when you look at the year-over-year numbers,
the comps get better.
The comps get dramatically better.
Yeah.
So literally by doing nothing except moving the months forward, our year-over-year inflation numbers are going to start looking better and better, whether he raises rates or not.
So inflation could come down by 2022-23 a bit. That's the consensus view. But here, I actually disagree with most mainstream investors. I think inflation will be far worse than is generally assumed. So why do I think that inflation is going to be a problem that's worse than is generally assumed? There are so many reasons, it's hard to list them all. There are continued lockdowns in China. Shanghai is under a strict lockdown. That means that problems in the supply chains will persist for the time being. But it's not just delays in existing supply chains. It is also that supply chains are changing as such. So yeah, I don't think you can just turn back time to before 2019. We're not just going to go back to importing gas from Russia when this Ukraine war is over. Also, we have printed a lot of money. All this eat out and help out stuff and paying people a lot of money, even though they're not working during the pandemic, that's going to have consequences, I think. And don't forget about climate change. We may see floods, wildfires. These things are very expensive too. And the scary thing is it's really more a when than an if. Which reminds me, the IPCC came out with its latest climate report on the very last day of March 31st. And to have a chance to keep global warming to under 1.5 degrees of pre-industrial levels, that's the 2015 Paris goal, we would have to cut greenhouse gas emissions by 25% by 2030. Right now, 2022, they're still going up. Also, there are lots of other political problems. It's not like the Ukraine war is the only horrible thing that's going on in the world. Countries in the Middle East, like Iraq, have about 2 months of stocks of wheat left. Then they need to buy wheat on the market, and it's very expensive right now. Last time stuff like this happened, we saw the Arab Spring and lots of political turmoil. And there are lots of unresolved crises all over the world, in Libya and Lebanon. So we have a lot of problems in the world, okay? And I believe over the coming months, more and more people will come over to the camp that says that inflation is a serious, sustained issue, and then they should want to buy more dividend-paying value stocks and commodity stocks and gold stocks. Those are exactly the sorts of stocks that I own. So if this outlook from now into 2023 is sort of correct, then the kinds of stocks in my portfolio should overall do relatively well. Of course, I also have some growth stocks in there. Funko came out with really good earnings.
Funko isn't playing games with its profit outlook for this year. The toy maker issued guidance that was notably above analyst estimates despite various inflationary pressures.
We are organizing for the future growth, whether it's the Pop brand or the Loungefly brand or some of our more emerging brands like Toys and Games and, the digital brand with Digital Pop NFTs. But yeah, we're always focused on innovation, on how we continue to evolve the brand.
Okay, that's all I think I had to say about the month of March. I am continuing to enjoy my investment journey, and I'm looking forward to seeing what the future may hold. So long.